Look at this balance sheet for TR Steel Private Limited. In fixed assets, they bought a decoiling and slitting machine for 42 lakh rupees. To sawal ye is, why doesn't spending 42 lakhs immediately bankrupt the company on their profit and loss statement today? The answer comes down to a fundamental accounting rule that separates an asset from an expense. It's based entirely on the duration of the benefit received from that spending. Because a heavy machine provides long-term value over many years, we capitalize it. It goes straight onto the balance sheet. But if we pay for daily routine maintenance, that only provides short-term value, so we expense it immediately on the profit and loss statement. By capitalizing the equipment, the company avoids showing massive, inaccurate profit swings on the day they invest in their own infrastructure. But that machine won't last forever. The physical wear and tear it experiences needs to be accounted for. That's depreciation, the process of slowly converting that capitalized asset into a non-cash expense over its useful life. We can calculate this using the straight line method. You take the original cost, subtract the estimated salvage value, and divide by the useful life. If a machine costs 10 lakh rupees, has a salvage value of 2 lakhs, and lasts 5 years, the math gives us 1,60,000 rupees. This chart shows the annual depreciation over those 5 years. You'll notice it's a perfectly flat line. Under this method, the company records an equal depreciation expense of 1,60,000 rupees every single year. Let's check the real numbers. Looking at TR Steel's income statement, we see the actual charge for their specific decoiling machine right here in the expenses, 51,666 rupees for exactly 2 months of use. The straight line method is straightforward, but it assumes a piece of equipment provides the exact same economic value on its very last day as it did on day one. We know that's not how heavy machinery actually works. Equipment loses value much faster in those first few years of heavy use. This graph compares 2 different approaches to that reality. On the left is our straight line, but on the right, the written down value method models more realistic accelerated wear and tear. The mechanic of the written down value formula is how you apply the rate. You calculate the depreciation as a fixed percentage on the opening book value for that specific year, rather than the original cost. Let's run the year 1 calculation. 10 lakhs multiplied by a 10% rate gives us 1 lakh in depreciation. That leaves a closing value of 9 lakhs. For year 2, that 9 lakh closing value moves down to become our new opening value. Now, let's test this. Video ko pause karo and calculate the exact depreciation amounts for year 2 and year 3 using that same 10% rate. For year 2, 10% of 9 lakhs is 90,000 rupees. That leaves an opening value of 8,10,000 for year 3, which gives us a depreciation of 81,000 rupees. The expense shrinks annually. For certain industries, this is a more accurate model. It matches the highest expense periods with the years the machine is brand new, running at peak efficiency and generating the most revenue. If a company decides to change their depreciation method midstream, they have to recalculate the historical depreciation from the date of purchase. Any difference between the old method and the new method is adjusted through the current profit and loss statement. Looking at TR Steel's P&L, non-cash depreciation expenses combine with operational costs to create a net loss of 4,360,456 rupees. This fundamental accounting equation in action means that exact net loss flows directly from the income statement onto the balance sheet, reducing retained earnings. No cash left the bank account when the company recorded its depreciation. But as the machinery loses value, it acts as a force that reduces the shareholders' overall net worth. Take a screenshot of this ledger to master these core rules. Keep these formulas handy whenever you need to categorize expenditures. Mastering these classifications provides a precise understanding of how long-term investments impact the ledger well beyond simple cash movements.